10 popular money rules. We've been told these money rules are unbreakable. Save 6 months of expenses. Never use credit cards. You need $1 million to retire. But what if those rules are actually broken? The truth is, these so-called smart money tips get repeated so often, people stop questioning them. But behind the surface, many of them are outdated, misleading, or flat-out dangerous. In this video, we're breaking down 10 popular money rules that sound like good advice, until you actually try to live by them. And rule number 10. It's a financial commandment nearly everyone follows blindly, without realizing it can quietly destroy your future. So before you follow another tip from your favorite guru or finance app, watch this. Section 1. You need $1 million to retire. You've probably heard it your whole life. You need $1 million to retire. It sounds like solid advice. Until you realize most people never come close. According to federal data, the average American retiring at 65 has just around $200,000 saved. That's not even a quarter of the so-called magic number. But here's the twist. Most of them are still retiring. Because retirement isn't about hitting some mystical 7-digit goal. It's about cash flow. Think about it. Someone living in a quiet rural town with paid-off bills and low expenses might live comfortably on $30,000 a year. Meanwhile, someone with luxury tastes and constant travel could burn through $100,000 annually and still feel broke. Retirement is personal. It's about creating a stream of income that supports your life, not someone else's spreadsheet. So while the $1 million goal sounds impressive, could mean working longer, stressing more, and missing the chance to actually enjoy life. Because at the end of the day, retirement isn't about how much money you've stacked. It's about how well that money works for you. And that brings us to another rule people love to quote, but when real life hits, it falls apart fast. Section 2. Save 3 to 6 months of expenses. Save 3 to 6 months of living expenses. That's the emergency fund advice you've probably heard 100 times. And while it sounds responsible, here's the reality. Most people can't even save 30 days. Studies show that a huge portion of adults couldn't cover a $1,000 surprise expense. So when we talk about saving 6 months, for many people, it's not just unrealistic, it's borderline impossible. But here's the kicker. Even if you do save that much, it might not be enough. If you're retired and living on Social Security, one broken air conditioner or sudden medical bill can wipe out that entire cushion. On the other hand, if you're in a dual-income household with stable jobs, you might not need the full 6 months, because you have a fallback already built in. In other words, this rule works in theory, but in practice, it depends on your life, your risks, and your reality. So instead of blindly aiming for some number you read on a blog post, ask yourself, what would actually keep me afloat if things went sideways tomorrow? Because money advice isn't helpful unless it's adaptable. And speaking of one-size-fits-all rules that don't quite fit, let's talk about budgeting, specifically the one formula that sounds smart, but often fails hard. Section 3. The 50-30-20 rule always works. The 50-30-20 rule is everywhere. 50% for needs, 30% for wants, 20% for saving or paying off debt. It's clean. It's simple. It feels like the budgeting answer everyone's been waiting for. But here's the harsh truth. Real life doesn't fit neatly into clean percentages. What if your rent alone eats up 60% of your income? What if your car breaks down the same month you're hit with a medical bill? Or maybe you're just starting over, after a divorce, a layoff, or a massive move, and your spending is chaos for a while. The 50-30-20 rule sounds great on paper, but for people dealing with tight budgets, inconsistent pay, or major life transitions, it becomes more of a guilt trip than a guide. And when a helpful rule feels impossible to follow, people tend to give up on budgeting altogether. So instead of trying to force your life into fixed ratios, flip the script. Start with your real expenses. Look at what you actually spend. Then build a flexible, evolving budget that moves with you, not against you. Because good advice isn't about being perfect, it's about being practical. And that brings us to a classic piece of financial wisdom that might be doing more harm than good, especially if you've been told to never trust credit. Section 4. Only use cash. Never use credit cards. Cut up your credit cards. Only use cash, so you feel the pain of spending. That advice used to be everywhere, and for some people, it worked for a while. But here's what they don't tell you. Avoiding credit entirely can actually set you back. Sure, swiping cash might feel more real, but in today's world, having no credit history can destroy your chances of buying a car, renting an apartment, or qualifying for a loan. And here's something even more dangerous. Cash and debit cards come with very little protection. If someone steals your debit card, your entire bank account could be drained. But if they steal your credit card, you're usually liable for no more than $50, and that's if you even have to pay at all. Credit cards, when used strategically, offer protection, rewards, and a track record of financial responsibility. So instead of saying, never use credit, the better advice is, use credit. Don't abuse it. Pay it off in full. Keep your balances low. Build trust with banks and protect yourself from fraud. Because in today's economy, building strong credit isn't optional. It's power. But money isn't just about technical strategy. It's also about mindset. And if your mindset is money above everything, you might be chasing the wrong goal entirely. Always be your top priority hustle. Grind. Stack that paper. We're living in a world where money isn't just a goal, it's a personality. But here's the ugly truth no one wants to say out loud. Chasing money like it's your only mission. That mindset can ruin you. People who obsess over wealth often fall into one of two traps. Trap 1. They become so afraid to lose money, they never take smart risks. They save aggressively, invest nothing, and wonder why nothing's growing. Trap 2. They sacrifice everything else, relationships, health, happiness, just to keep the grind going. And then there's the third option, the people in the middle, the ones who see money as a tool, not an identity. These are the people who build wealth and still enjoy life. Because let's be honest, money is important. But when it becomes your obsession, you don't own your money anymore. Your money owns you. So the next time someone says money should always be your number one priority, ask yourself this: at what cost? Because true wealth isn't just about the dollars. It's about the life they let you live. And nowhere is that more obvious than in the next myth, a lie we've been sold for decades, especially in college. Section 6. Student loan debt is good debt. Student loans are good debt. That's what they told us, right? The logic seemed simple. Go to college, get a degree, land a high-paying job, easily pay it back. But for millions of people drowning in student debt, that formula didn't play out. Here's the uncomfortable truth. Student debt is only good if it actually leads to more income. Taking out $100,000 to become an accountant? Maybe. Taking out $100,000 to get a philosophy degree with no job in sight? That's not good debt. That's just expensive wishful thinking. And let's not forget, student loan interest adds up fast. Miss a payment, and suddenly your $40K loan turns into $55K. The worst part? You can't even bankrupt your way out of it. So is education valuable? Absolutely. But that doesn't mean every degree is worth any price. The smarter move. Think about return on investment. just like you would with any other business expense. Ask, what will this degree earn me? And how long will it take to pay off? Because if the numbers don't add up, it's not education, it's a liability. And speaking of liabilities, let's talk about one rule that sounds smart on the surface, but could quietly rob you of decades of growth. Section 7. Pay off your mortgage before investing. Paying off your home sounds smart, right? No more debt, no more monthly bills, pure freedom. But here's the catch. While you're focused on killing that mortgage, you're missing out on compound growth. Every year you delay investing, you're losing years of return. If your mortgage rate is 3%, but the market average is 7 to 10%, you're locking up your money in a low-yield asset. That's not financial freedom. It's a missed opportunity. The smarter approach? Use a blended strategy. Invest while paying off your home. Grow your future without delaying your peace of mind. But there's one money rule people still whisper like gospel. Section 8. Don't talk about money. Never talk about money. It's a rule passed down for generations. But is silence really safe? Sure, don't brag about your bank account, and protect your private info. But avoiding all money conversations? That keeps people ignorant and vulnerable. Financial literacy grows through discussion. Learning from others' wins and mistakes is how we all get smarter. So yes, stay private about personal numbers, but share the lessons, ask the questions, break the silence. Because when you don't, the only person that benefits is the one keeping you in the dark. Now on to one of the most outdated money myths of all. Section 9. You must retire at 65. Age 65, the magic number for retirement. Why? Because of Social Security? Medicare? Here's the truth. That number was picked generations ago. It's not written in stone. Some people retire at 40. Others keep working into their 70s because they love what they do. Retirement isn't about age. It's about freedom. If you've got the means and desire to walk away sooner, do it. If you love the hustle and want to keep going, do that too. The point is, don't let society's timeline dictate your dreams. And finally, let's break the most common sense rule in personal finance. Section 10. Never carry a credit card balance. This rule sounds ironclad. Never carry a balance. Ever. But what if your car breaks down and you have no savings? Or your medical bill hits before payday? Sometimes carrying a balance is your only option. Now, should it be your first option? Of course not. But shaming people for using credit during an emergency helps no one. The key? Use credit strategically, not emotionally. If you carry a balance, make a plan to eliminate it. And always, always, build your emergency fund when you can. My personal closing thoughts for you. So, how many of these smart money rules have you followed? And how many might actually be hurting you? The truth is, personal finance is exactly that, personal. What works for one person can be a disaster for another. So don't follow every rule blindly. Question everything. And build a financial life that actually fits you. Stay upright and healthy, and hopefully see you next time.